All right, welcome to day 4 of the advanced trading course. So today we're going to go over setting up your charts, and we're going to also look at daily charts and understanding the importance of finding triggers and recognizing windows or pockets of safety for both long and short positions. Okay, so let's see. Lost my mouse there. Okay, so charting is technical analysis, right? Technical analysis is a form of interpreting price action in critical areas of support and resistance. So there's a lot of different forms of technical analysis that are within charting, but charting by itself is very technical, right? So we can be fundamental traders, we can be value investors, but for the most part, I'm a technical trader. Right? I'm a pattern-based trader, and because this is a chart pattern that I'm looking at, not a earnings pattern or a cyclical sector pattern or something like that. It's a chart pattern. It's a technical pattern. That's the type of trader that I am. Okay, so by using technical analysis, we can look at charts and we can find areas where we're most likely going to have a large number of either buyers or sellers, depending on what the patterns are telling us. Now, when we get to these critical levels, we'll often see large amounts of volume coming in. So the volume, just like we've talked about in the last few days, is confirming that retail traders and possibly institutional traders as well are interested in these stocks at these critical levels. Okay, so we can learn to anticipate where the volume will come in. We learn where the breakouts are, areas on the chart that are very common for a lot of shorts to cover or a lot of buyers to come in for a potential squeeze. And by anticipating these, we can have our orders ready to go. So when we start seeing the volume, we're ready to jump right in. That's really important. It gives us a little bit of an edge or a leg up because we're already watching the pattern unfold. We don't have to wait for some of these stocks on an intraday basis to hit a high of day scanner. We're already watching them before they hit the highs. So when they are hitting highs, we're already in. Okay, so and then on the other hand, by purchasing these stocks right at the breakout spot, we avoid holding during consolidation. Right? On the other day, class 2, we were talking about risk management, and one of the areas of risk is our exposure in just the amount of time we're holding stocks. So if we can reduce our exposure by holding a stock for a shorter period of time and still generate a significant profit, then that's really good, right? So that's what I always aim for. As much as I can, I want to get a relatively quick profit, right? That's the goal. And sometimes I end up holding longer, but I'm able to time my trades based on recognizing patterns and anticipating where big volume is going to come in. Okay, so there's different types of analysis, technical analysis versus fundamental analysis. And there can be some overlap between these two types of analysis when you decide to get in a position. But here's the thing. You never want to, just the way we don't want to adjust our stops to accommodate a bad position or a losing position, we don't want to start doing fundamental analysis to justify holding a losing trade, right? If we're in a trade like Nike and all the technicals are saying get out, and then we think, well, Nike's a strong company and I really like sneakers, maybe I'll hold it. We're starting to combine fundamental analysis. Well, retail is a good sector right now, and the shoes are really popular among teenagers, and I think I'm just going to hold this for maybe a couple weeks and see what happens. And then what you've done is you've changed your risk parameters mid-trade to accommodate a loser. So we never want to do that. And one of the problems that a lot of fundamental traders will have is that the fundamentals may be very good, but the price action doesn't follow. So it's very confusing when you hear a stock has bad earnings and then it's trading up, right? Or it's got good earnings and it's trading down. It's very hard to understand at times why the price action seems to defy what's logical in terms of a fundamental analysis standpoint. But it happens a lot. So for me, I've just learned that I really can't get caught up in doing the fundamental analysis, and that's why I don't do a lot of research late at night and stuff like that. I'm not digging into reading all the earnings reports and digging into all the news because I found that it really didn't help me. Even when I thought I understood the news, and maybe I did, the price action might do something differently, and we just have to follow the price action. For the most part, we're getting in these trades on the 5-minute chart. So we're going to trade them on the 5-minute chart. And fundamentals on 5-minute charts pretty much don't matter at all. The fundamentals are applied more to daily charts and for swing traders, either short-term swing traders or even, mid-term and long-term investors. But on an intraday level, we have to focus on technical analysis, and that's where we focus on charting. Okay, so technical indicators are a complex set of formulas, and they give us context for current price action. So some indicators are oscillators. They go up and down with price action. So, if an oscillator is bottomed out at its low, that's telling us that typically that the price action of the stock is also bottoming out. Now, if we just look at the stock, we can bypass the middleman, which is that indicator, and see that the stock is bottomed out. On the other hand, it can be helpful to have that histogram or that oscillator, whatever visual representation you have of that indicator. It can be helpful to have that there just as confirmation that this stock is really bottomed out. And of course, a stock that is completely bottomed out could be a good candidate for a bottom bounce. So seeing that number on something like RSI, that you've got a 4 or a 3 RSI, it's just additional confirmation that this stock is really hitting the lows, and at some point it's got to bounce. But it doesn't by itself mean we should buy. Just because something's hitting a 5 RSI doesn't mean it can't still sell off for another 2 or 3 points. So we can't rely on technical indicators to give us our entry and exit signals. There are certainly some systems and some traders that have tried to rely on, a red light, green light type of indicator system where, whenever something meets this formula, they buy, and whenever it's, like this, they sell. But typically, anytime those work, it's going to work for a short period of time, and then it's going to stop working. And one of the reasons is when you do a back test and you have the computer system run the test of this formula over a set of 2 months, you'll get the results, and you'll look at the results, and then you'll start tweaking the formula. Eventually, you tweak the formula enough so it returns a beautiful profit curve, a really, really nice looking gain. Right? So you think, okay, I've got this formula right here, back tested over the last 2 months, it looks terrific. Then you run it live for a month and it loses. And you think, what the heck? And you do the back test a month later, and the result that was 80% is now 50%. And so you go and you start tweaking it again. And what you end up doing is tweaking these indicators to match. You're actually matching the indicator to a set of back test results. So they have no future and forward value. They're only valuable looking backwards, right? So that's one of the big problems that I ran into when I was trying to write algorithms, is that every time I thought I was close and I had something that looked really, really good, you can't future test. You just run it, and the results wouldn't be not even close to what it appeared that they should be. And that just kept happening again and again and again. So eventually I realized that trying to be, an algorithmic trader or rely on technical indicators was just not going to work for my style. It wasn't profitable, and so I had to focus instead on patterns that have more consistency. And maybe you can't scan for them, and you can't write formulas for these bull flags and flat top breakouts, but you can visualize them, and you can use your own analysis, right? That's where the human comes in, and this is really our advantage over the high frequency traders. We come in, we analyze the visual aspects of these patterns, and we're able to make a decision. So technical indicators, in general, I don't rely on them. I use them just to confirm what I may already suspect. So if I suspect a stock is bottoming out and I look at the RSI and it's at 5, then that's just confirming what I already see. So I use it only in that way. And it's also worth noting that technical indicators lag behind price action. They get their information from the candlesticks. And so it takes a little bit of time for most of these indicators to form their signals. So, whether it's 5 minute delay or 10 minute delay or just a minute delay, they're usually lagging indicators. Okay, so an example of a few lagging indicators would be the relative strength index, okay, MACD, money flow, the alligator indicator, which is just a moving average crossover. Um, and there's hundreds of indicators, but the whole problem is that these are lagging, and as day traders using 1 minute and 5 minute charts, we can't tolerate the lag. I mean, the lag time is going to ruin our chances of having profitable trades if we wait for that to give us our entry or exit indicator or signal. Okay, so um, now the area where you can do a little bit of combining the technicals and fundamentals for me is when I'm preparing my watch list in the morning, and I want confirmation that there is a fundamental reason why the stock is going to go up. Okay, just beyond the technicals. The technical says the stock is gapping up 80%, but from a fundamental perspective, why is it gapping up? What is the catalyst? Okay, so knowing that there's a fundamental catalyst, whether it's earnings or some type of activist investor, an FDA approval or clinical trials, whatever it is, I want to know that there's a reason. And I want to be able to do a little bit of research and get a few other opinions. And I can do that in a lot of ways just by looking through social media. I'm obviously not going to base my investment choices on random opinions on social media, but they can help me form my bias for whether this is a long or a short. Just by looking through the collective opinion of people on StockTwits and Twitter and that sort of thing. So in that way, each morning we can do a little bit of a combination of technical and fundamental analysis. We look at the technicals, we confirm the gap, we confirm that this stock is going to have high relative volume, right? We check the float. We see how many shares have traded pre-market. We look at, of course, the daily chart, which we're going to talk about here in a few minutes. And then we start to figure out what is the news on this thing. If all those technicals check out, well, now what are the fundamentals? And it could be, well, this is a stock in the oil sector, and that sector right now is very weak. So maybe we don't even want to trade it because we don't like the sector it's in. Or maybe we see it's a pharmaceutical stock, and that's a really hot sector right now, so that makes it even more exciting. Okay, so it is important to understand some of the basic fundamentals, but you don't, at this point, at least in my opinion, have to dig into, the detailed research and stuff like that. We're day traders. We're not holding these overnight. We're not holding them through earnings. So our risk exposure is really a lot lower than someone that is a longer term investor. We don't need to do all that research before we buy something. Okay, so in terms of setting up your charts, I think a cleaner chart is a better chart, so I would say throw away all the technical indicators and rely mostly on moving averages and candlestick patterns, right? And the candlestick patterns are just going to form naturally. And you'll see on my charts that I do have a few indicators on there. I certainly don't rely on them, but they're there and they can be helpful at times, and they can be helpful for students as well, which is one of the reasons I leave them on, especially for screen sharing and that sort of thing. Okay, but in terms of the moving averages, I use the 9, the 20, and the 200 exponential moving averages. And I also use the volume weighted average price, which is called the VWAP. So the volume weighted average price is a moving average that takes into account how much volume is trading at these different prices. So if you have an area on the chart that's mostly flat and then has a big spike up with volume, the VWAP is going to spike up sharper than a moving average, which doesn't care how much volume goes off. It's just looking at the high and the low. Okay, so the VWAP is in a lot of ways sort of the equilibrium balance point of a stock over the course of the day. So when we think about the rubber band concept, which is the price action, just think of it as a rubber band. And when we start to shoot up and get really, really extended, that rubber band is getting stretched out. Okay, so getting super stretched out. And we know when these stocks get really extended, either to the upside or the downside, inevitably they're going to bounce back. And the point where they bounce all the way to equilibrium and the rubber band is just loose in your hand, that would be the VWAP. Okay, and we don't always make a full return to the VWAP. Sometimes we, just sort of spring down a little bit and then spring back up, and we make waves and continue up and don't make a full retracement to kind of equilibrium point. But that is what VWAP is, and I do find that helpful, especially if I'm looking at a trending chart. A chart like what was it today? Um, bind today. So this one we were watching, and I've got a lot of drawing trend lines on here, but right in this area from, let's say, uh, this blue line to this blue line, I was watching it for a potential reversal, but the problem is that this orange line, this orange trend, this orange moving average, that's the volume weighted average price, and we were consolidating below the equilibrium point. So that by itself is a little bit of a bearish indicator, right? I'd rather see this stock consolidating along the highs. On the other hand, the VWAP is telling me this is a little bit below the equilibrium point of the day, but I should be able to recognize that anyways because look at the stock. It moved up from 727 up to $10 and is now consolidating around 790, $8. So it's retraced more than 50% of its move up. So just from a visual standpoint, without the VWAP, we can already see that the stock has pulled in a little too much, and we're probably going to be a little cautious with buying it for a long position when we're below the VWAP. So a question here, is the VWAP my profit target? When I'm trading a reversal, say I decided to short this up at $10 off the highs, the VWAP could be my profit target because that would be the equilibrium point, right? That would be the balance point for this stock today. So the VWAP would be a potential profit target, but typically we don't see a retracement all the way to the VWAP. We usually see a retracement first to the 9 moving average, then to the 20, and then if it's really coming in, maybe down to the VWAP. So when I'm shorting stocks or taking a bounce play on a stock that's been selling off, I use the moving averages as my target, and the VWAP would be, the ultimate target, and maybe I'm still holding a 8th size position by the time we get up to the VWAP. So I'd probably be mostly scaled out with my final sale target at the VWAP. Okay, so we'll go back in here. Okay, so and the TAS market profile indicators, I'll review those in just a minute, and we'll go over those more later in the class because they are sort of complex in the best way to use them. So that by itself is a whole class. But for right now, focus primarily on just your exponential, just your regular exponential moving averages and volume weighted average price and candlestick patterns. The TAS market profile indicators are only available on eSignal. Actually, they might be on a few other platforms, but it's a third-party software provider, so they're not a standard indicator that's just available. You do have to purchase that third-party software package. So it's something that you could look into. I think it gives a lot of insight, and it can really help new traders see charts a little more clearly. If you feel you're a little more experienced, then you may not need them. Okay, so now on time frames, I have 3 charts that I'm always looking at. Okay, the 1 minute, the 5 minute, and the daily. Now, there's a lot of traders that think the 1 minute is too choppy, and so they might just look at the 5 minute and the daily. Personally, I use the 1 minute quite a lot, especially at the open, right? A lot of these candles that we're looking at, the first 5 minute candle at the open, I mean, it could be a 10% move. So when there's that much volatility, I need to be looking at a shorter time frame. A lot of my first trades I get into at 9:31, 9:32, and I may be able to scale out half of it the way I was today for a 10% profit within the first 5 minutes. So I need to be able to see that price action a little more clearly. So at the open and during the day when we have breaking news, I pull out the 1 minute chart. If you're not a breaking news trader and you're not trading at the open, then you could get away with just using the 5 minute and the daily. So that's going to depend a little bit on your strategy and the time frame that you feel most comfortable trading. Now, in terms of the daily, I certainly look at the daily for areas of resistance, but when we have a good catalyst, the 5-minute chart for me is really where I'm going to look for my patterns, and that's where I'm going to base almost all of my trades and setups, is the 5-minute and the 1-minute, and less so on the daily. Okay. So there are some traders that believe you have to have a strong daily chart in order to trade a stock. And I used to feel that way. I used to do a lot of scanning in the evenings looking for good daily charts. But what I found, and I've said this before, is that we would see a really great daily chart like Blue, the stock chart that we were looking at the other day. Great daily chart. And then when we get the breakout, no one's watching it because there's no catalyst. So the breakout is very poor. And on the flip side, you might have a stock that has a horrible daily chart, but it has a huge catalyst, and that overrides the poor daily chart. So in a perfect world, the perfect setup is going to have a strong intraday chart and a strong daily chart. But I'm willing to take trades on stocks that have a really good intraday catalyst, like earnings, news, etc., but have weaker daily charts. Okay, so when I say a weak daily chart, what would make a daily chart weak? Okay, and for me, that would be a chart that has a lot of nearby resistance or is blocked by moving averages. Okay, it could also be a stock that has very, very little volume, so its average daily volume might only be 5 or 10,000 shares. That's going to be a little hard to base any of the candlesticks in the past few months to use them for any real area of resistance when such little volume occurred each day. And again, an amazing daily chart with no intraday volume is really not worth trading. This is where you get into playing games with the algorithms and the high frequency traders. And if you've ever tried to play chess against the computer, they always win. So it's a game not worth trading and not worth playing because you're not going to win. So that's why instead we just focus on the high volume stocks. Okay. So here's an example of a bad daily chart. This is Lululemon, and we had a big gap up. Okay, we had a big gap up, but when we looked at the daily chart, there weren't a lot of areas of real open, no resistance, clean windows. Okay, the only one was when we opened here, we had this blue line, which was the low of this orange candle here, and that's colored orange with one of the indicator packages I was running at the time. So the low of that candle looks like was 44.08. So the biggest window was from the low of that candle to the high of that candle. And the high was 45.75, looks like. Okay, so about $1.75. That was the biggest window that we had. Okay, and right at the open, we broke up through the low, 44.08, and surged up almost to the high, and then we pulled in. And when you look above that high of 45.75, well, where's the next level of resistance? It's very close by. Okay, well, what about after that? Again, very close by. And after that, close by, close by, close by, close by. And we also have a moving average coming down here. And this moving average could potentially block us from getting much further above that line as well. So you have a couple of issues here. One, this stock has a moving average. Two, it has one window, but it's not a very big one. And then three, beyond that first window, there's just a ton of resistance. So when I say, look at Lulu, this is gapping up, is there a good trigger on this chart? And you could say, well, it looks like there's a trigger at 44.08 that opens us up to 45.75 right here, and then that's it. Okay, so this isn't horrible for a like a trade right out of the gates, but beyond that, it's pretty weak. Okay, and what we ended up seeing was we squeezed up to that point, and then we came in. All right, so even though we had a pretty good gap here, and we had a lot of volume, it was okay for a trade, but this wasn't a stock that had a daily chart set up to do like a really massive move. So there was too much resistance blocking the way. Okay, so in contrast, what makes a daily chart strong? So the first thing I look for are these windows, and I mark them out with trend lines. And I also look for areas of ascending and descending resistance lines. So that's a good question. Are resistance lines more important to watch for than the moving averages? I would say moving averages are going to be more closely watched by retail traders than trend lines. And we'll talk about that in a couple minutes. But basically, trend lines are, to a certain extent, they're a little bit arbitrary, right? Because we all might draw them a little differently. So it's hard to pinpoint the exact penny where trend line resistance could come in because it might be a little different for your chart versus my chart or someone else's. But if we have a very clean, well-respected trend line, then it is something to definitely consider for resistance. Okay, but we'll look at that again in just a second. So windows are very important. I look for windows on a chart, and a window is a large area with no support or resistance. Okay, so this large window can be formed by either a gap or a large candlestick, but it has to be one or the other. Now, a really good window has the average true range of the stock encompassed in that window. Okay, and the best setups have several big windows all lined up. So one after the other after the other. Now I just made a mention there of the average true range. The average true range is just the average range a stock will typically trade in one day. Okay, so some stocks might trade a range of 15 or 20 cents in a day, right? Bank of America, its average range is only like 30 cents, whereas other stocks are going to have a very high ATR, average true range. So I like stocks that have an ATR of at least 50 cents. And the reason is the more they move, the easier it will be for me to capture a little bit of that move in the form of a profit, right? A stock that only moves about 10 cents, I mean, I'm going to have to capture almost the entire move in one whole day in order to make my profit target. Whereas a stock that has an average true range of $5, it's going to be much easier for us to find a small area on that chart to pull a piece of that profit, right? To get out a little bit of that $5, even if it's only 50 cents or 60 cents. There's much more. There's a lot more opportunities with a stock that has a higher ATR. Every time we get a flag break, there's a potential that the flag will break and squeeze up 40, 50, 60 cents. Whereas Bank of America, it'll squeeze up 5 cents or 6 cents. Okay, so higher ATR is better when we have windows that encompass the full ATR. For me, that means it's a very big window. Now, window, at the top and bottom of each window is a trigger. Okay, so a trigger for me is just a price where when we break that price, we get into a window. Okay, now what's the difference between a trigger and a resistance point? They're basically the same thing. Okay, now the only difference is that a trigger for me is it's going to be a potential area of resistance because we're at the bottom of a window. But there's the potential if we break over that little area of resistance that we open all the way up to, $2 before we run into any more resistance. Okay, so I would call that penny, that line, a trigger. Now, if at that line we had another form of resistance about 5 cents away, then it's really not a very good trigger, right? It's just a line of resistance. Okay, so when we look at triggers, we want them to be extremely obvious. The more obvious they are, the more retail traders are going to be watching it and buying at that same point, or perhaps covering their shares at that same point. So we don't want to overcomplicate it, and I'll show you some pictures of charts so you can visualize this a little bit better if you're more of a visual learner. But what we want to look for are the windows, and remember that the bottom of the window is a trigger, the top of the window is a trigger if another window is stacked right above it. Okay, so triggers versus resistance, I kind of just went over this. So the good triggers are going to have an ATR encompassed in the window. That makes the trigger really powerful. So if the next area of resistance is only 10 cents away, there's not much power behind that line in the sand, and it's really going to be more of a form of resistance than a real trigger. So a strong daily chart here on WB. All right, so on this stock above 24.48, there is absolutely no resistance. Okay, but let's look at this because this chart actually had several pockets, several windows, and that's why it had such a massive day right here. Okay, this is a day where it went from $21 up to $25.50. All right, so let's look at this chart here with more trend lines. Okay, so WB, so the first trigger on this one, let's see, well the first one was this orange candle. Okay, so the high of that orange candle right there, 22.12. Okay, now above 22.12 we had a little bit of a blip right here, which is the top of this doji. So that made 22.12 a potential area of resistance, but if we could break over that and get over the doji, then we have room up to 23.32. And if we could break 23.32, the next logical place for us is to go right up to the highs. Okay, now I would say this right here, the high of this candle, could be a potential resistance as well, because right here you've got a high so close to it. But if we can get above that, and because this is a recent IPO, this is the line in the sand that is really going to be catching a lot of people's attention. Okay, so this is what I do every day when I pull a stock off our watch list, off our gapper scanner. I start marking out trend lines of nearby areas of resistance. So if I was marking out this chart, I would probably throw in a trend line right here, and I'd probably throw in one right here as well. But these are the ones that are the most critical. Okay, so now with the trend lines, when you're drawing trend lines, the important thing to note is that the more times a trend line has been tapped, the more validity it gains. So a trend line that's been tapped only twice, once where you first drew it and then the second time where you connected it, might not be very strong because it's only tapped twice and it's possible that no one is watching it. Okay, whereas a trend line that taps multiple times is going to be a little bit more respected by the price action. Okay, and I'll pull up an example of this in 1 second. So, but first, let's look at this gap up here and an example of a window with no resistance. Okay, so this is a window right here. We have this gap. As soon as the stock starts to break into the window, we're going to have the potential for what's called gap fill. Okay, the stock could sell off all the way down to this level of 1986 because there's really no support here. The only area of support that we could catch is moving average support. So if we were looking to short this, we would say, well, this is gap fill. So we're getting into the gap, and this is a very significant trigger, 22.12. But we do have a moving average right here that could be an area of support. Okay, so that's where the moving averages come in handy. Now, here's one that's a little bit better. This is a gap, and this is a big window right here. Right? See how big that window is from 614 all the way to the high here over $7. Okay, so once we get into that, we have no resistance, right? And we're above our moving averages, so that makes it even cleaner. So that's where we get that really nice move. We got the first break, and then the second day was a follow through. And you notice the volume was higher on the first break than on the follow through, and that's typical. Okay, now this one here is an example of Bind, the stock we were trading today. Okay, so this was gapping up here, opening at 727, and where was the first big trigger? It was at 845, right here. And above 845, 1065. So that's a big window. This is a really nice trigger right here at 845. But we do have a moving average here that comes down, the 200, and that could be a little bit of a problem. All right, but the first issue is from the open up to 845. That's our first area of resistance, and guess what? When the stock opened, it popped up to 845 and then pulled in. All right, second move was up to 849. So this little area on the chart was probably being watched by a lot of traders. So to answer your question, when I draw a trend line, do I draw it on the daily time frame? And the answer to that is yes. I use trend lines on both the daily time frame and intraday charts. So let's look at this chart on Bind here. We'll go full screen on this. Okay, so usually what I do when I'm looking for any area of potential resistance, I just look at the stock, and I usually, in terms of trend lines, I can sort of start to visualize them just by looking. So right in this area, I can see there's a little bit of a trend line. Okay, so there's a little bit of an area of descending resistance as we come down. Okay, so that one I can see. Looks like there's a little bit of a support area right here. Okay, so the more times it's touched, once, twice, three, four, and then five, six, and then breaks through it a couple times, seven, eight, the more validity it has. Okay? So, what's interesting is that sometimes you'll put on a trend line like this, and then you'll notice way back over here that the stock almost is bouncing up against it a couple times, and then breaks through it, and then it's held here. So sometimes these trend lines actually remain in play for a long period of time when they're well respected. But again, it's a little bit more arbitrary because it's how I chose to draw it. And we can see here how this just barely touches that candle. Well, look, I draw this just a teeny bit differently, and it makes a big difference over the course of several months, right? So, um, depending on how it's drawn, you could see the potential break areas down the road much differently. So that's why I don't usually leave them on because I do think they're a little bit more arbitrary. But when I'm looking at the price action for the last, the last couple weeks or something like that, I'll definitely use it. So bind here, the first thing I marked out was 845. Then we've got the 200 right here at 898. And we've got a little bit of an issue there at 790, but we broke through that without much trouble. And now what's formed here is a window between the low of day today and 549. So this window in the future could be an area for potential gap fill, just the way that window right there from 1189 up to 1269 is still an open window. It hasn't been closed by price action. Okay, so that window will remain open. Now, let's see, so this trigger at 1065, actually it should be 1075. 1075 is actually the proper place for that. The high of that candle right there. So that was my mistake, but yeah, 1065 was the day before. But in any case, so that's drawing just the flat trend lines. Now on a stock, let's look at. Got to think of a stock that might have some good trend line potential. This one's a little too crazy. ISIS. So, okay, we've got ISIS here. This has obviously been trending up for quite a while. Usually when I draw a trend line, I exclude the candle wicks. So I usually look to include the whole bodies, but if there's a big tall candle wick, that can kind of mess up my my trend line just because of the fact that this one day we had a big candle wick that broke through the trend line and then price action came back below it. So a lot of times I find it's more accurate to draw against the real body when I'm drawing trend lines. Okay, but in this particular case, this has also been pretty choppy the last few days, and there's not a really clear trend line on the top side, but there's a little bit of support here on the bottom side. So a little bit of support coming through here, and you can see the trend line or the candle wicks break through it right here once and right here a second time. But for the most part, it's being respected. Now, what some traders would do, let's see, copy. I haven't done this on. Let's see. I wonder how you do this. All right. Well, I guess this is something that you can do in TC2000, but maybe not in Trade Ideas or e-signal. But what some traders do is they create a matching trend line at the same angle. Let's just say that's the same angle, and then would offset it. So what you can sometimes find are channels. Okay, so this would be looking for potential channels, and a lot of stocks will trade in channels. Okay, so some traders, especially swing traders, are going to look to trade stocks on bounces off the bottom channel and bounces off the top channel as stocks are trending inside these channels. But this is not really a stock that has an excellent channel, so it's not the greatest example of that. Okay, so this was our example on buying today, stock gapping up, um, and and let me just go back to this for 1 second. Just to fully answer your question, you can use trend lines. You can see the way I had a trend line drawn right here pre-market, and I said this kind of looks to me like a little bit of a descending wedge, right? We've got support at 713 and we've got a descending resistance line. So this to me looks like a little bit of a wedge, and that is a bit of a bearish pattern. So I'm not crazy about the fact that this stock is trending down. We're holding along this $7 support line, so it's not like a loss of support where we're just making new lows, but it is a little bearish. So I was a little unsure about that one. So I will draw a trend line for that type of for that type of setup. And then during the course of the day, I may pull out my trend lines again. And let me just move this one out of the way. I'll move this one out of the way too. Okay, so what I might do is just look for areas where we potentially have some support or resistance. So on this stock here, you can see when this area broke, a lot of volume came in. So a lot of people were kind of watching this for that trend line to break, right? This was kind of the fact where, all right, we've made one attempt at moving back up, couldn't do it. Second attempt, couldn't do it. Okay, now we're consolidating. Well, where's the line in the sand where it's probably going to sell off? And once it broke below that trend line, the sellers really piled in. Okay, so, and we can do the same thing for the upside, have this sort of trend line where we see, okay, this is a resistance on the upside. We only have 1 and 2 taps, and it's a fairly steep line, but you can see because the stock sold off so much that it is possible that trend line was a little bit of an issue right through here. So I do use these for flag patterns, and I find it helpful to draw these lines and just gives me a little bit more of a visual of the patterns. Now, I don't draw these trend lines on every stock because I can visualize where the trend lines are, but I do think it's helpful, especially for new traders and just for the sake of practice, that you draw these trend lines and take screenshots of them and save them. And that way you can look at them later and start to get a little bit better at recognizing the patterns. Okay, so trend lines, you can use them on the 5-minute, the 1-minute, the daily. I don't have it set where daily trend lines are going to overlay into my intraday chart. That's something you can do, but I find it really messy when I do that sort of thing. So I just have them separate on each time frame. All right, so a couple more gap examples. This right here was a pretty big pocket in the chart. Okay, so we had a big gap down, and that created a big window. Okay, so the windows can be either big gaps or very big candlesticks. So gap there, another little gap there, and big candlesticks like this green candlestick, once we start to get selling, that green one can be a little bit of a window to the downside. So I made a mention of gap fill. That's simply when the gap is filled by price action. Okay, that's pretty self-explanatory. So gap fill is something that we aim for stocks that make small gaps up. We look for them to gap down. Or when a stock is approaching the trigger line of a gap window, we can look for potential gap fill all the way to the other end of the gap. Okay, so that in certain cases could be a really big move. Gap fill, a full gap fill seems to be more common on the selling side with stocks that are just grinding down all day long and sell off all day long versus stocks that are moving up. But gap fill is kind of like the VWAP, where that may be our ultimate trigger or our ultimate target, but typically we don't fill the entire gap. But if we get halfway there and it's a 10-point gap, then we still have $5 of profit potential. All right. So if you want to scan for daily charts, you can use stock charts, FinViz. Trade ideas can also be used for scanning daily charts. Like I said, I don't do a lot of it, but you can if you want. When I see a good daily chart, I create the price alert in eSignal, right? And then I pretty much forget about them until the price alert comes back up. So let's say on Bind, I want to set a price alert based on the daily chart. And let's say I want to set it at $10 or let's say $10. I'll go to add alert, right click, add alert, bind at or above, I'm going to say alert me if it's at or above 985. Okay. Expiration time, I won't have it expire. Show pop-up and play sound. You can have it email you too, but I don't want to do that. Accept. Now it's live. Next time it comes up to 985 and is getting close to that 1004 spot, it'll notify me. I don't have to think about it. Okay, but as beginning day traders, you have a lot of work. Adding more work right now is not really that necessary. So, in terms of doing daily homework of scanning for daily charts with really great triggers, you can do it if you want the practice, but I don't think it needs to be part of your daily routine, right? It's not part of my daily routine, and I'm doing fine trading. So I don't think you need to focus on that too much. Instead, spend your time relaxing, taking a little break, and then get up a little early in the morning so you can do the research pre-market. One of the worst things you can do is wake up at 9:25 when the bell rings at 9:30, because there's no way you're going to be able to do your research, and you're going to be kind of groggy, and you're not going to be able to focus or take trades right at the open. And 9:30 to 10 a.m. is when I make the most money. So you want to make sure you're up early enough to take full advantage of the opening range, the easiest time to make money. Okay, now if you want to look at some daily chart patterns, the flat tops, the flat bottoms, the bull flags, and the bear flags, you can click this link here and take a look at it later. The chart patterns that we're going to go over on Monday, on the intraday charts, they're the same patterns that we'll see on daily charts. The only difference is that for me, they're much more important on the intraday charts because there's more volume. Okay, so a flat top on a daily chart, how well respected is it going to be when it breaks out? If no one's watching the stock, no one's going to care. It might break by 10 cents and then pull right back in. So I don't do a lot of scanning for the daily chart patterns, but the patterns will be the same patterns that we look at for intraday charts. Okay, so setting up charts, we do this to give us a better understanding of the context of current price action. Okay, so this allows us to make well-educated decisions, reduce our risk as traders. And again, this is just another level of risk management. Everything that I'm doing when I'm trading stocks is finding ways to mitigate risk. Okay, so I've got my risk management principles, the 2-to-1 profit-loss ratios, right? Aiming for a percentage of success of at least 50%. And then I have making sure I'm only trading the right stocks, right? I want to trade the high relative volume stocks with a good catalyst. Okay? And then I want to make sure my charts are set up properly and I understand the value of triggers. And I understand what makes a chart strong or makes a chart weak. Okay, so these are all levels of varying degree of risk management. And it's what helps us trade safely and hopefully trade with positive profit-loss ratios and a high level of success. Okay, so anyone watching on the recording, feel free to shoot me an email, ross@daytradewarrior.com. And anyone else that's watching right now on screen share, you can put out your questions in the chat room.